In this week's video, we'll cover numerous charts that may change your perception of the stock market's outlook over the next 5 to 15 years. On June 5th, 2018, we were 130 days from the S&P 500's peak that occurred on January 26th, 2018. This is a daily chart of the S&P 500 in early August of the year 2000, which is 130 calendar days after the market peaked in March of 2000. We are using the generic and for illustrative purposes only exponential 5-week moving average in blue and the exponential 10-week moving average in red. Similar situation here. Same moving averages, same weekly chart, same S&P 500 index, 130 days after price peaked in October of 2007. If we compare these charts to the same chart with the same moving averages in the present day, it'll help us assess the probability of consolidation breaking to the upside eventually and being followed by a series of higher highs relative to the probability of consolidation breaking to the downside and being followed by a series of lower lows. 130 days after the peak in 2018, this is the look of the same moving averages. Let's compare and contrast apples to apples. All three charts span 1-year periods. All three charts show us the market's profile 130 days after the peak, and we're looking at basically the same number of calendar days heading into the peak. Since markets are forward-looking mechanisms, the market's assessment of the probabilities in the future and the facts in hand are important prior to the peak and after the peak. Both provide us with useful information. This is a much more confident look heading into the peak relative to this look here and this look here. And in both of these cases, bad things happened after these low conviction looks heading into the peak. In the first case, over the full 1-year span, we had 1, 2, 3, 4, 5 bearish moving average crossovers. The second case, we had 1, 2, 3. Compare and contrast this confusion and indecisiveness to the present day, which over the exact same 1-year period had 1 bearish moving average crossover. This looks like confusion and waning conviction. This looks like confusion and waning conviction. This looks more like a confident, sustainable trend followed by a correction and a reversal. 130 days after the peak, we have a new bearish moving average crossover with blue mathematically below red. 130 days after the peak in 2008, we have had a bearish moving average crossover in place for several months, and the moving averages are making a new 1-year low on the chart. Contrast that with the present day, where we just had a bullish moving average crossover, and instead of the chart deteriorating, it has an improving look. There's no question, based on the facts in hand as of June 5th, 2018, the probability of good things happening, looking out several weeks, months, and years relative to the probability of bad things happening, is much, much better here than it was here or here. We make decisions based on the facts in hand. We'll continue to take it day by day. If the facts deteriorate, we're happy to reassess those probabilities. Similar situation here. To make it simple, we'll continue to look at 130 days after the S&P 500 peak. These are the same weekly moving averages. This is what the NASDAQ looked like 130 days after the S&P 500 peaked in 2000. This is the look 130 days after the S&P 500 peaked in 2007. And as you might guess, the present day look looks infinitely better 130 days after the peak than this look here or this look here. This looks like indecisiveness, an attempt at a bullish turn, and then failure. This looks like a reversal, a meager attempt at a reversal, and a resumption of this downtrend. Right now, based on these higher highs, this looks like a market that needed to consolidate its gains via a normal and 100% to be expected correction, followed by a resumption of the bullish trend. Those statements are based on the look of the chart as of June 6, 2018. Those statements have nothing to do with forecasting what the chart will look like in the future. It's simply a commentary of the facts that we have in front of us. We feel much better making decisions based on facts relative to highly unreliable forecasts. Let's look at this bullish moving average crossover 130 days after the peak in 2018 and this bullish moving average crossover 130 days after the peak in 2018 in the S&P 500 in the light of the big picture. This is our value line geometric index. We had a rally, price was rejected in 1998, came down, found a bottom in 2002, rallied back to basically the exact same point in 2007. Price was rejected again. The market found its footing in 2009, rallied back to the exact same area in 2015, and for a third time was rejected. What once acted as resistance, what once acted as resistance may now act as support. Right now, on June 5th, 2018, the date of this chart, this looks like a bullish breakout and a successful retest of these levels here. If we look at the weekly version, we move above this line here, get a breakout, a successful retest, followed by a higher high. We consolidate after this bullish breakout, get a successful retest of this orange line here, and then the retest is eventually followed by a higher high. This is a breakout above this consolidation box here. This looks like a breakout and a successful retest. If the pattern continues, we would expect to see a higher high above these highs, and that's to be determined. But relative to the big picture context that we have today, that's a reasonable expectation from a probability perspective. When it happens and if it happens is to be determined. We'll continue to take it day by day. NYSE Composite 1973 to 2018 as of June 7th. The market needs to consolidate its gains. We go sideways from 1997, revisit the same basic area in 2002, and come back to the same area in 2009. This is what consolidation looks like. I can't really do anything like that over here. This is what a trend looks like. You can draw a horizontal line from 2007 to 2013 to 2016. Price is rejected at the green upward sloping line here. We come back to the same line and we're rejected again. Then we have a bullish breakout above the green line and what looks like a retest. Now, we remain above the green line. The longer we remain above it, the more convincing it becomes. This looks like a trend, consolidation, and what may be the start of a new trend. Might be a little bit easier to see on an annual chart. A trend, consolidation, what once was resistance may now act as support. When the strong trend was waning here, the Bollinger Bandwidth started to roll over, coinciding with the period of consolidation. Contrast that with the present day, coinciding with the bullish breakout, a retest, and a higher high Instead of rolling over as it did in the late 1990s, the Bollinger Bandwidth is now turning up from low levels. This is our sleepy, trendless market that's trying to wake up. All of these statements are based on the facts in front of us. It has nothing to do with a prediction. If the facts change, our assessment of the probabilities will change as well. Market fractals tell us that the concept of a strong trend followed by consolidation, followed by a resumption of the trend, applies to all time frames. In the present day, the NASDAQ weekly 2017, we have a strong trend, what looks like consolidation, and it's possible that we now have a resumption of the previous trend. Easier markets, this is our easier market, are followed by harder markets. This is our harder market. Eventually, harder markets, this is our harder market, are followed by easier markets. We don't know whether the easier market is a bullish breakout or bearish breakdown, but in both cases, we would go from a trendless market and revert back to a trending market. It appears as if we are trying to revert back to a bullish trend based on the fact that we've exceeded this high here that was made in March and exceeded the high that was made on the weekly chart in February of 2018. If it seems unreasonable that this chart could move in this direction for a long period of time, or it seems unreasonable that this chart could move in this direction for a long period of time, that's understandable. Following an 8-year rally off of a major low that occurred in 2009, an 8-year plus rally here, it seems logical to say this can't continue. In the mid-1970s, we have an 8-year rally off of a low. It would seem logical at this point to say this can't continue. In this case, after a long-term consolidation period, a bullish breakout, a successful retest, and a higher high, not only did the rally continue after this 8-year move, but it continued for 18 years, and the market tacked on an additional 729%. This move here, bullish breakout and retest, you can make an argument, is similar to this 8-year move here, this bullish breakout, retest followed by a higher high. Is it possible for the market to rally for 8 years off of a low and then rally for an additional 18 years? The answer is absolutely positively yes, because that's exactly what happened here in the 1970s and into the 1990s. It's not a forecast, it just helps us keep an open mind about better than expected outcomes and puts the present day in a long-term historical context relative to how markets operate in the real world. And if this type of move seems ridiculous, it might be worth finding this short takes post dated May 14th, 2018. It contains charts, text, and a video on the psychology behind "this will end badly." You can find it by Googling the title S&P 500 Retracements followed by the name of our blog, Short Takes, and you should be able to find this link here where my cursor is in the search results. And you can find more information in present-day charts about easier markets followed by harder markets in this See It Market post dated June 7th, 2018. It contains charts of growth stocks and additional charts of technology stocks, and in this case it uses ETFs. From a psychological perspective, the long-term chart of the NASDAQ is also telling us to keep an open mind about better than expected outcomes. Contrast this 16.66 year period where the market made absolutely positively no progress with this 16.66 year period that featured a gain of over 1,500%. The market needs to consolidate its gains. It's exactly what happened. Easier markets are followed by harder markets. Harder markets are typically followed by easier markets. The longer a market goes sideways, 16.66 years. In this case, the bigger the move that we can expect to get when we get either a bullish breakout or bearish breakdown. In this case, we have a bullish breakout until proven otherwise. The same concepts apply to shorter term time frames. How do we know we have consolidation? We can draw horizontal lines and hit price numerous times. It's possible this is our harder market, and this breakout tells us to keep an open mind that we might be moving to an easier market. The model is based on the weight of the evidence. Global stocks are also telling us to keep an open mind about better than expected outcomes. Prices in the same place in 2004. We can draw a horizontal line and hit it again in 2009. That's consolidation. Prices in the same place 2006, 2007. We can draw a horizontal line, hit it again in 2015, 2016, and 2017. This is a form of consolidation. Harder markets are typically followed by easier markets. Right now, this breakout in the global Dow is still holding as of June 7th, 2018. A chart like this always begs the question, shouldn't we have exposure to global stocks? And the answer for our approach and our time frame is not yet. We need to see more. We're happy to add global stocks. We're happy to add gold. We're happy to add silver. We're happy to add oil. We're happy to add energy stocks. We just need to see it supported by the facts that we have in hand rather than anticipating what may or may not happen in the future. We know from past videos that all things being equal in the markets, simple is better than complex. From a price action perspective, if we look back 1 year from the close on June 7th, 2018 to the close on June 7th, 2017, despite the recent pullback, the S&P 500 is tacked on 13.86% in the last year. So we have to ask ourselves, price action here exceeding expectations. Price action here, for many people, exceeding expectations. The fact that the market never made a discernible lower low here, for many people, is exceeding expectations. Price action since Brexit, price action since the U.S. election, all of this, the fact that the NASDAQ's already made a new all-time high, the fact that small caps have already gone on to make a new all-time high, growth stocks posting new all-time highs. All of that taken together, asset class performance, the charts we've covered in this video. If we take all of that as the weight of the evidence, does the evidence align better with the bearish hypothesis that we're making a major top, or the bullish hypothesis that we've been covering in these videos over the past 2 years? As of the close on Friday, June 8th, looking back over the past 5 trading sessions, the S&P 500 was up 1.62%, the NASDAQ tacked on 1.21%, and the Dow posted a gain of 2.77%. Once again, do these numbers align with the theory that this is a normal correction within the context of an ongoing and existing uptrend, or the theory that a new bear market has started? And it's always good to keep reminding ourselves, under our approach, our objective in a market like this is to try to navigate from a point A to a point B that could be several years down the road. In this case, from 1984 to this peak in 2000, the S&P 500 returned an eye-popping 822%. And we know with 100% certainty between this point A and this point B, there is going to be some gut-wrenching volatility. In fact, as the stats will show on the next few slides, we learn next to nothing when we ask this question: how is the market doing today? That really doesn't tell us anything about the market's health or the primary trend. From point A to point B, there were 3,873 trading days. 54% of them were green and 46% of them were red. The signals that we covered in the November 10th, 2017 video, do they align with the "we're making a major peak" hypothesis? Or do they align with the hypothesis that says we should keep an open mind about better than expected outcomes for many years to come? During this 19-year period, asking how's the market doing today didn't really tell us much. There were 4,758 trading days in this 19-year period here. 54% of them were green. 46% of them were red. The average gain, roughly 0.5%. The average loss, roughly 0.5%. It's very, very easy to get lost in the day-to-day volatility if we're watching the market too closely. Regular viewers and clients know we've been drawing comparisons to the 1995 period for some time now. This period, 1,306 trading days. The S&P 500 navigating from a point A to a point B several years down the road. If you were able to do that and capture even a portion of the 228% gain, most likely you would have been very pleased. Once again, watching the market closely was not particularly helpful. 56% of the trading days were green, 44% were red. The average down day was basically the same as the magnitude of the average up day. The market wants to take us off our game. It wants to confuse us. Asking the question, how's the market doing today? Not particularly helpful when the primary trend is down either. 354 trading days, a 57% loss, roughly a 50-50 split between green and red days, 49 to 51, and the magnitudes very confusing. The average loss, 1.82%. On down days, the average gain, up 1.46%. Notice in an uptrend, volatility is a normal part of the trend. Counter trend moves are 100% normal and to be expected. The exact same thing applies when you're trying to hold your long-term defensive portfolio during a primary downtrend. There are going to be gut-wrenching and 100% to be expected counter trend moves where your defensive assets are not performing particularly well. There is volatility to ignore on this chart when we're in an uptrend, and there's volatility to ignore on this chart when the primary trend is down. Moral of the story, it's never easy, especially if you're watching the market tick by tick. We also know from past videos that discerning between volatility to ignore within the context of an existing and ongoing uptrend and volatility to respect, where the data is telling us we may be rolling over from a primary uptrend to a primary downtrend. If we're able to do that and mitigate some of the damage on the way down, it can significantly impact the quality of your life. Buy and hold works until it doesn't. 1984 to 2000, gain of 822%, primary trend up. 1995 to 2000, gain of 228%, primary trend up. 1954 to 1972, gain of 376%, primary trend up. 2007 to 2009, primary trend down, loss of 57%. My $1 million would have turned into $430,000. And that's why we're constantly asking the question, does it look like a normal pullback within the context of an ongoing uptrend, or does it look like something more ominous where we may be rolling over from a primary uptrend to a primary downtrend? While the big picture looks constructive at the present time, we have no idea how long that will last. Thus, it is not a question of if another devastating bear market is coming. It is simply a question of when. It does not appear to be imminent right now. However, if you don't have a plan in place, it's going to be very, very difficult to formulate one from a position of psychological weakness where you're seeing a lot of red on the screen during the down days and the primary trend is down. We're much, much better off formulating that plan while the market is healthy and while the market is closed, when we can think clearly and prudently. So regardless of whether or not the markets are breaking out to the upside and we're moving to an easier market, or if consolidation is going to continue in the shorter term, it's extremely important for us to avoid these common missteps that can derail us when we're trying to capture what could be a very, very satisfying return between a point A and a point B that could be several years down the road. Another good source of information if you're skeptical about the possibility of markets exceeding expectations for many years to come is this July 28th video. You can find it by Googling this title here. You can find the November 10th, 2017 video by Googling this title here. Whenever we talk about the long-term potential of the stock market, a fair question is, what about valuations? We will provide a brief two-part answer to that question. The markets in August of 2000 were well aware of valuations, and the chart reflected that here. When valuations became a problem, it was reflected in all of the charts and all of the hard data. When the problems related to the financial crisis became a problem for the market in 2007 and 2008, all of that fundamental information was reflected in the charts and the hard data. In the present day, the market is well aware of present-day valuations, and the market has a strong opinion about the short-term, intermediate-term, and long-term outlook for both earnings and valuations. Thus, if valuations become a problem, and that absolutely positively may be the case, it will be reflected in the charts. If we're going to go into a multiple month or multiple year downtrend, this chart of the S&P 500 will not look like this, and the chart of the NASDAQ will not look like this. So when we monitor the market's net aggregate opinion, we are always monitoring the market's take on all fundamental questions, including valuations. I said it was going to be a two-part answer. Part 2. How helpful are PEs from a market timing perspective? If you Google this title here, you can find an analysis on See It Market dated January 8th, 2017. And I might add that the market is much higher today than when this was posted in January of 2017. It walks through market history with PE ratios, allowing us to answer that question. How helpful are PE ratios in terms of timing the market? How about the Shiller PE? A similar analysis walking through the market step by step with the information that you knew at the present time. You can find that analysis by Googling this title here. This post is on our website and our blog, Short Takes. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.